Are we live now, Emily?
We are live.
All right, let's get into it. So hello, everyone. My name is Natasha Hicks. I am a supervisor at PKF Mueller. I've been here for about 6 or 7 months since the beginning of the year, and I work in their tax department. And today, my colleague, Dan Patterson, and I are going to discuss the, maybe not so new, but definitely updated and improved employee retention credit. So Dan, go ahead if you want to introduce yourself right now.
Hi, thanks, Natasha. Hi, everyone. Good afternoon. I'm Dan Patterson. I've been with the firm for going on 5 years now. I am a senior in the Client Advisory Services Department, and I have lots of experience with payroll-related items. I do a lot of payroll tax returns, so this credit is definitely relevant in that area. So we have a lot of information to go through today. We're going to try to get through all of it, and hopefully we have a little bit of time for questions. But also, anybody who does have questions during our presentation, feel free to create the question in the chat, and we can answer those live while we're doing it. And we also have the power to go back and answer those chats after this meeting. So if you have questions and we don't have time at the end, we can still answer those just at a later date. Without further ado, Natasha, if you just want to jump right into it.
All right, so I did a little presentation about this earlier in the year. So as I go through, I'm just gonna give like a sort of a brief refresher of what the credit is and who may and may not claim it. Then we're gonna let you know kind of what the benefits are to claiming this credit, because they're gonna be different whether you're claiming this credit in 2020 versus tax year 2021. And then we'll give you some examples. And I think that's the good part about this. We're going to try to give you some examples of that clarify some of these newer rules. And most importantly, if you got a PPP loan, what is it going to look like in practical terms when you're trying to file that application for your PPP forgiveness, and you're also trying to claim the ERC. So as we're going through, like Dan said, you can put your questions in the chat box, and hopefully we'll get to that, following our presentation. So as I was saying before, most of us are probably familiar with the ERC. Oh, I can't, my slides aren't moving, Emily. Having a little bit of technical difficulty. Let's see. Is someone moving the mouse? Okay, there we go. I think that's me. So most of us are probably familiar with the ERC, as it was originally introduced back in 2020 with the CARES Act. But since it was introduced, we've now had a lot of legislation concerning this credit. So we've had this credit be amended first with the Consolidated Appropriations Act back in December of 2020. And then that act opened it up. So in the beginning, if you got an ERC in the beginning, you could not get a PPP loan during 2020 and vice versa. But what the Consolidated Appropriations Act did was open this up and say, now you can go back and retroactively claim both an ERC and a PPP, as long as you don't use the same wages. And then it also extended this credit to the end of the second quarter of 2021. There's been some more legislation with the American Rescue Plan Act, which introduced 2 new types of businesses that could get this, these financially distressed businesses that are eligible for this credit. And then we still have those frequently asked questions that the IRS put out that, they might not have been updated, but they have not been, fully superseded. So we know that the ERC was originally set to expire in December of 2020. And what it is it's a fully refundable credit that employers can receive. Sort of, the IRS introduced it as an incentive to keep employers, to let them keep their employees on the payroll while we went through what we thought was going to be a few weeks of a global pandemic. So as we can see, you know, it's 16 months later and we'll 16, 18 months later, and we're still dealing with COVID-19. And because of that, the IRS has said, we're going to expand this credit now all the way through the end of 2021. And so now you can go back and you can retroactively claim this credit beginning in March 13th of 2020. And then you can keep getting this credit every quarter as long as you qualify all the way through the end of December of 2021. The credit is available to all employers who carry on a trade or business between that time frame, as long as you meet at least one of two qualifications. And those two qualifications are you have to have either experienced a government shutdown due to COVID-19, or you experienced a significant decline in gross receipts due to COVID-19. If we go through the slides, you can see that I put a lot of detail in them. I've given you a lot of examples. I've given you some of the things that are going to be updated, but we're not going to go through that, but just so you have it for your reference. What we are going to go through there are sort of three things that if you are claiming this credit, whether it's in 2020 or 2021, they're all going to be the same. These three universal rules are going to stay the same. And the first one is you have to, you know, show that you had either a government shutdown, we'll go through details about that a little bit after this, or a significant decline in gross receipts. And the IRS is going to have you compare your distressed year to 2019. So this is kind of confusing for some people since this has been expanded to 2021. A lot of people want to compare, you know, 2021 to 2020, but no, whichever year you're using, you're still going to compare it to 2019. And then probably the one that we've had the most questions about it, you know, are the aggregation rules. The aggregation rules are going to apply whether you're claiming this credit for 2020 or 2021. And the IRS has given us some examples and set forth those aggregation rules in Code Section 52A and 52B. And what this means is that if you are a member of a parent subsidiary group, which means that we have a controlling parent who owns at least 50% of the subsidiary's voting power or stock, then you're going to have to be treated as one employer. Even if you have, you know, distinctly separate types of operations, you're going to be treated as one employer for ERC purposes. The brother-sister rules also apply. So if you have 5 or fewer persons, estates, or trusts who are owning more than 50% of the stock of that corporation, then you're going to be treated as one. And then if you have 3 or more corporations that are a part of a controlled group, you're going to be treated as one. And these rules are also going to apply to partnerships in the same manner that they apply to corporations. So that's the first step. You're going to look at your business and you're going to decide, you know, if you have 2 or more, if you have 3 businesses, you're going to look and you're going to decide, am I a member of an aggregated group? If you are a member of an aggregated group, then you're going to be combined for really 4 things. You're going to be combined when you determine whether your trade or business has been fully or partially suspended. Now, this can kind of work in your favor because, you know, let's say you have a few businesses and only one of them was shut down. Well, if one of them was shut down, then you can still get this credit for all the wages paid during that period when you were suspended. You're also going to use this aggregation to determine whether there was a significant decline in gross receipts. And I think, you know, this is where it gets a little tricky because we might have one business that might have been an essential business that was fine. Nothing happened. And then we have another business that was completely shut down. And we'll go through an example of how you aggregate and let you see that it has to be treated as one business. You're also going to be aggregated when we're determining how many employees you had in 2019. Remember, that's our base year. So we're going to look back to that year and determine whether we were a large employer or a small employer. And we're also going to be looking at that to determine the maximum credit. So a lot of businesses, especially small businesses, they might have, 3 little businesses, and some of those employees work for each one. I might have, Dan work for each one of my businesses. You only get to use that employee one time. So once that it is determined that you have an aggregated group and you guys qualify for this employee retention credit, all you're going to do is take the wages for each one and just separate it. This group gets a third, this one might get a fifth, this one might get a half. You're just going to separate it in that manner. So let's say you're a member of an aggregated group. You've determined that you think you guys are going to set aside these requirements. Next thing you got to do is determine if you were a part of a government shutdown. If you're one member, at least one member of your group experienced a government shutdown. And what this means is that you were forced to stop your operations for a period of time. And you couldn't have group meetings. Let's say, you couldn't get together for business, for social, for religious reasons, or commercial or religious reasons, then that is considered a government shutdown, as long as it's from a, official government order. So one thing they talk about is press releases. If we have like a mayor that says, oh, you guys should stay at home because it's not safe, that's not going to qualify. What you're going to need is a government order that says you cannot have business operations. The next thing is if you're an essential business. I've gotten this question a lot. So essential businesses were allowed to stay open. Even if you're an essential business and you don't necessarily qualify because you weren't shut down, you can still qualify if you had a supply of your critical goods or materials disrupted. The IRS has given us some rules about this, and they're saying as long as your business was shut down or more than a nominal portions of your business operations were interrupted. So what does that mean? Like, let's say, for example, you might run a store. So let's say you've got a party goods store and you sell people everything that they need to have their parties with. But you also have, like, let's say you have a back room or a few back rooms where you actually host parties for individuals. Well, the IRS, let's say they said, you can still sell party goods, it's fine, or you can sell that online. And because of that, your sales went way up in that particular portion. But they also said you can't gather for social events. So that means your party room was completely closed. Well, the IRS gave us a little bit of guidance, and they said, go back to 2019. Take a look at your store and your party room. And if your party room was more than 10% of your sales in 2019, then you qualify as having your business partially shut down. And you, even as an essential business, can get a part of this ERC credit. Another thing is, if your business if the government order imposes a curfew that affects the operating hours of your trade or business. So let's say, you had a trade or business and the government says, or the local government says, you have to shut this business down 3 hours early so that you can clean and disinfect everything. Well, the IRS says if you were subject to that order, even if you're an essential business, you can still get an ERC credit for 2020 or for 2021. The one thing to note, I have a little example here, is that if you get an ERC credit based upon the fact that your business was shut down, you're only going to receive the credit for the time that your business was actually shut down. So when we take a look at our example, we have this particular corporation that was ordered to shut down from March 17th to April 17th. And then the business just decided to stay closed a little bit longer just to be safe. In this case, since the government order was only from March 17th to April 17th, the employer is only going to be allowed to get the ERC for that particular period of time. So let's say you are an employer and you've decided to shut down your business slides again. There we go. I get it. It's just taking a little bit of time. Okay, so let's say you are an employer and you've decided that you don't qualify. Your business wasn't shut down. You didn't have that type of business. You can still apply for the ERC and try to get this credit based on a significant decline in gross receipts. When we talk about gross receipts, this has been another question too. What is the IRS including in these gross receipts? Essentially, they're talking about the sales from your normal business operations, and they're including a few other things. So, if you have, they're going to rents that you received, if you have some investments that you received, then you're going to be able to, that's going to be included in the gross receipts portion. And the difference is going to be whether you get, when you're talking about declining gross receipts, there's going to be a big difference depending on whether you're talking about claiming this credit for 2020 or whether you want to claim this credit for 2021. If you're claiming this credit for 2020, once again, we're going to look back and we're going to, go to 2019 and we're going to say, what are our normal gross receipts in 2019? And then we're going to say, I'm going to compare my first quarter of 2019 to my first quarter of 2020. And if there has been a more than 50% decline in gross receipts, then you as an employer can receive a credit of 50% of up to $10,000. So that's how this credit works for 2020. So in 2020, the most that you can get is $5,000. And, when we go through our example or when we go through the more details of 2021, you'll see that with the Consolidated Appropriations Act, this credit has been expanded. This, what the IRS did is they changed it from having to have more than a 50% decline in gross receipts to only having a more than 20% decline in gross receipts. They also said that instead of capping this at $5,000 per employee, what we're going to do is we're going to give you $28,000 per employee. And so first thing you need to do is, I give a little example of, how you're going to aggregate it. It's easy. You take your credits, you take your company in 2019. If you have two companies here, we've got A, we've got B. What we're doing is we're taking this company's gross receipts in 2019 for A. We take their gross receipts in 2020 for B, and then this is what they were in 2019. Then when we aggregate them, this is what they were in 2020. And what do we have? Only a 40% decline. So that means, no, you don't qualify. Then we do the same thing here. Aggregate this company. We found that we have a 55% decline. So yes, we qualify. And this is really important because once you determine that, you qualify, let's say we're talking about 2021. Once we determine that you qualify for this credit, you're going to keep getting this credit. So in 2021, once you determine an employer qualifies, you get $7,000 for that first quarter. Then you can try this all over again. The second time, you're going to get $7,000 for that second quarter, and you're going to keep getting that $7,000 per employee, up to $7,000 per employee until the quarter following the quarter when your receipts have gone up above 80%. So if we look at this example, we can see that in this third quarter, our receipts have gone up to 85%, which is more than 80%, but you can still receive it through this quarter. And then for that next quarter, you'll have to try and get this credit all over again. All the time. Having a little bit more technical difficulties. Somebody moving their mouse. Hmm. Hopefully you guys can follow through at home. I'm having a little bit of technical difficulties with moving my slides, but I'm going to try to just go on ahead.
Natasha, I think if you use your mouse to click through the slides, you might be able to do it a little better.
Okay, that might work. Okay, let's see. Planning on this happen. Go back to where we need to be. And yeah, oh, there we go. Just try to get us back. Okay, let's see if we can get back on track. So once we've determined, so let's just kind of go through what we've gone through so far. So what we've gone through so far is that there are 3 things that you're going to have to use if you're trying to claim this credit, whether 2020 or 2021. And those 3 things are, we're always going to look back to 2019. That's our normal year. And then we're going to say, how does our distressed year compare to our normal year? And then we're always going to say, do we qualify under one of these 2 rules? Did we have a significant decline in gross receipts, or was our company shut down due to a government order? And then we're going to apply the aggregation rules. Once you apply the aggregation rules and determine that you qualify for this, the next thing you're going to do is determine what are the qualified wages that you can use to claim the ERC. What the IRS has said is that there's certain wages that essentially what it is just going to be your Medicare wages. You can also use those Medicare wages that you pay to your employee plus certain health plan costs, as long as they were pre-taxed by the employee. But there are also certain wages that you cannot use. So they've given us a list of wages that are not eligible for the ERC. And essentially, those are the wages of the people who are related parties. So if you have a more than 50% owner of a corporation, then you cannot use the wages of their child, their brother, their mother, their father, your nieces and nephews, and son-in-law, daughter. And you can't use wages if you are a self-employed individual. So if you're a self-employed individual, you cannot use your own wages, but you can use the wages for any of those people that are your W-2 employees. In addition, there are going to be attribution rules. So the entity to entity member attributions, family attribution, partner to partner attribution. So what that means is if you have a more than 50% owner in a business, and they have some other people that are related to them in this particular way, once again, you're not going to be able to use those wages. Once you determine what the wages are that you can use, we have a little example of what you're entitled to get in 2020 versus 2021. So, when we go through, we're looking at this first guy. He got paid in the first quarter $15,000, and then he got paid in the second quarter $10,000. But, even though he got $25,000 in wages, the maximum that you can get for each employee is $10,000. We can see that when we get to 2021, this rule is going to be changed, and you can get up to 70% of wages paid per quarter. So, it's going to be a totally different ball game. That first quarter, you got 15,000. Second quarter, you got 10,000. You're going to get 70% each quarter. So this person is going to get their employer a $14,000 credit for ERC. And the same thing here. It's going to be up to 70% of each amount that you were paid, and equals 1112. So we're not going to be capped at that $5,000. Once you determine that, you've got all you've gotten all the qualifications of those first 3 hurdles. The next thing you're going to worry about is what are qualified wages, because qualified wages are going to determine whether you are a large employer, or whether you are a small employer. And whether you're a large employer or a small employer is going to be very important for what you put on your ERC 941 at the end of the year. The IRS has said that a large employer is anyone who has, for 2020, more than 100 full-time employees. If you have more than 100 full-time employees in 2020, then you can only get the ERC for wages that were paid to people who were not providing services. When we talk about full-time employees, once again, we're going to look back at 2019, and that's anyone who worked at least 30 hours per week or had 130 hours worked in a month. We're not doing full-time equivalents. This is if you had an employee, if you had a full-time employer who worked a full year, you just take the full-time employees you had for each month and divide it by 12. When we go to 2021, a large employer is going to be anyone who had more than 500 full-time employees. So, you know, let's say you were an employer, you had 500 full-time employees, you paid each one of them $10,000. That means throughout the year, you could potentially get up to $14 million for this credit. So, you know, this is kind of a big deal. Let me give a little example of how this works. We've got someone who had fewer than 500 employees in 2019. You know, they're forced to partially shut down to 2019. In this first example, you know, he's paying 80 salesmen $80,000 in wages, even though they're forced to stay at home. He also pays the other 120 employees $120,000 to do curbside pickup and still work. And since this is a small employer, he can get the entire $200,000 that he pays these employees, both to work and to stay at home. On the other hand, you know, if I have more than 500 full-time employees in 2019, it's not going to work the same way. You know, if I've got 600 and during 2020 or 2021, there's a partial shutdown, and you pay 50 of your servers while they're not working and $550 to provide takeout orders, then this is going to cut your credit by a lot. You're only going to be able to claim the $50,000 paid to the servers who were not working due to COVID-19. And probably, you know, the thing that people are really kind of wondering about is, you know, how is this going to work? So if I have received a PPP loan and now I want to, you know, I want to qualify for forgiveness for the PPP loan, but I also want to receive an ERC, you know, what can I do to kind of make sure that I maximize both of these credits? And you know, the IRS has given us this example. They give us a bunch of examples. There's a lot of wording that's a little bit convoluted, but really what it boils down to is when you are filing your PPP loan application, only put the payroll on that is absolutely necessary, you know, for you to qualify. So, you know, if you've got a $200,000 that you need to qualify for forgiveness, but you only need $120,000 worth of payroll, then only put $100,000 worth of payroll. And then that $80,000, you know, try to make it up with, maybe you can do rents, maybe utilities, your mortgage, whatever it is. Because if you end up doing what most people were doing, which is, you know, most people might dump all of their payroll on the PPP application because they just wanted to make sure they got forgiveness. Well, when you're going forward for 2021, you want to make sure you get it right, because the IRS says if you put all of your payroll on this application, we're not going to let you then later go back and claim the ERC for those wages. So, you know, the best thing to be doing is kind of get yourself a spreadsheet. You know, we've given a few examples here of how this works. You know, this first one is the one that I talked about where, you know, you really only need $120,000 of payroll. So, you know, if you put that $80,000 on, if you don't put that $80,000 on, then none of it's going to be considered for purposes of the PPP loan, and then that just kind of wipes out your ERC. But let's say you did it the right way. You know, you're looking at this example too, and you're saying, oh, I could just put $80,000 of other eligible expenses on here. Then that means that you've left yourself open to claim the ERC for those $80,000 that you have left of payroll. And then that third example is just kind of, you know, what happens if you kind of mix a little bit of both. Let's say you included some of your other expenses, then the IRS is going to say, oh, okay, we'll let you put that $50,000 of other expenses on, but you also put $150,000 of payroll costs on. So essentially, you know, this is not really ideal either, because $30,000 of payroll costs that could have gone to ERC was essentially not included, or was included on your PPP loan, and you just kind of lost it. So the next slide that we're going to go through is kind of Dan giving you an example of really how that works. I've included two slides here that really just kind of help you determine eligibility. One is saying that the TAS has a website. You can go in, put your information in, it will help you. And then I've got a little decision tree that hopefully, you know, you can kind of follow the arrows, and it'll help a little bit. But, you know, at this point, I'm going to turn it over to Dan, because so that you can go through and kind of show them how it works from a practical standpoint.
Yeah, thank you very much, Natasha. You know, those are some great points that you made there, and you know, it's a lot of information so far with this credit. You know, but hopefully, you know, you guys at least now have an introduction to, you know, what this credit is, how do you even qualify for it, and then what's the benefit that you can get. And Natasha's touched on the calculation a little bit, but we definitely thought that one of the best ways that we could really show everybody what benefit you can get out of this is with kind of a small practical example. So in this case, we have 6 employees in this company, and we have a PPP loan that's for $40,000. And in this example, we're going to be in our covered period still. So what we need to do is make sure that our ERC is not being used in conjunction with our PPP funds. So we don't want to double dip, essentially, is the term that a lot of people are using for this. So we want to be able to show that if any of this gets audited or questioned, that we can show that the PPP wage amounts were not being used to qualify for the ERC. We're not using free money to claim free money, is basically what it comes down to. So if you can look, we try to put an example together that kind of shows you kind of all the different situations you might see, generally speaking. So you can see, like with our first person, David Adams here, you know, he had $8,000 in gross wages for the quarter, but plus his health benefit costs, we have total wages of $8,300 for him. Since this is a 2021 quarter where we're using this PPP, and you can get, and remember, you can get 70% of $10,000 per quarter, so potentially $7,000 per employee every quarter. So what we want to do is, since this David here has only 83,000, he's not maxed out yet. So we want to use all of his wages to qualify for the ERC. So we're going to take that 8,300 and take 70% of that. And then when we have a person like Melissa here who got paid 32,500 with her total benefits, she got 32,860. You know, we have an excess of 22,860 over that $10,000 maximum for this quarter. So let's use her total benefit of $10,000 for the ERC and then throw the rest of it to PPP so we can allocate the difference here. And so she still maxes out for the entire quarter with her $7,000. Same thing with Leslie. She just has a little bit with her health benefit costs. You know, she's 250 over. So might as well take her excess 250 and apply it towards the PPP. And she can still max out at this $10,000 for the total benefit of the 7,000. Morgan Freeman here got paid exactly $10,000 for the quarter. So in most situations, that would qualify for a maximum benefit of the $7,000. You can also see that we had some FFCRA credits that are used, which is, I'll talk about in my next slide, some other credits that you really can't use at the same time as ERC. But in Morgan's case, we need to take that piece out of the total wage amount because we can't double dip with this credit either. So you can see that we have the total unqualified wages for this person was $1,500, leading to an $8,500, 70% of that benefit. So we can still claim, $5,900 for this person. So even if you're using this with other credits, you can still have ways to try to maximize as much as you can for each person. And then the next person we have here is Angel, and we're gonna, in this situation, Angel is the owner. So even though Angel got $10,000 of W-2 wages for the quarter and 500 of health benefit costs, we can't use any of those wages since he's a 100% owner in this situation. So we're going to take this person's wages out. But what that means is that we still have PPP money to use. So we can put all Angel's wages towards the PPP to try to maximize out the PPP. And then Stephen here has made $40,200. And you can see that we only put $6,000 towards the PPP. And why is that? That's because we're already at our total of our PPP loan. So this allocation right here, we can prove that we used all of our PPP loan in this quarter during our covered period, and we weren't overlapping with our ERC at all. So we only had to use $6,000 at the end of the day. And obviously this is going to vary with other companies, but you can see how you can kind of mix and match with what wages you want to use for which one to make sure that you maximize out the people who aren't going to make that $10,000, and then you're going to have excess for all the people who made over that $10,000. So, so you can see we max this person out with $10,000. So our total benefit, our qualified wages is, $46,800, and we could take 70% of that. So in total, there's over $32,000 of wages just for this quarter. And then the next thing is with the going forward in the next quarter, we've already shown in this example that we've used the entire PPP loan. So on the forgiveness application, we can put this $40,000 all to payroll if that was the situation. So we don't have to do this allocation the next time. The only allocation you would have to do would be for other types of credits that you would not be able to use as well. And that's going to be on my next slide here. Excuse me. Okay, so so we already talked about the PPP and how you don't want to double dip with the PPP wages and the ERC wages. And so the CARES Act states some other credits that they don't really want you using with the ERC. So if you're using like the credit paid sick leave, the credit for increasing research activities, which are both items that are also on the 941 payroll tax returns. So those are things that by employee, you're going to see those amounts mostly on your payroll reports from your payroll company, or if you run your own payroll, hopefully you're keeping track of those hours that you're using those credits for per employee. So you could take that out of that individual's employees. And with those credits, there's really not a lot of room to play around with to add it to other people because those are specific to that employee. Whereas the PPP, you can, as long as you don't go over the thresholds for how much somebody can get paid with the PPP, there's a lot of room to kind of play around with those different wages and how you want to use them, apply them. The credit for active duty members, the credit for the paid family and medical leave, the worker opportunity credits, the empowerment zone employment credit, and the paid family leave credit. These are all different credits that they're saying do not use this with wages that you're applying towards the ERC. Essentially, we're going to say it a lot, just don't double dip with these credits is the main point. And then the ERC wages are not considered qualified disaster relief payments. The reason is the disaster payments do not include qualified wages paid by an employer. And so the next thing I want to talk about is, since we've already talked about what the credit is, the different areas that go into it and how you qualify for the credit in the first place, the aggregation rules to figure out, what you need to include in the qualification process. And then we've talked a little bit about, how to actually calculate out the credit and figure it out. It's the 70% of $10,000 for 2021, and it's the 50% of $10,000 for 2020. But how do you go about claiming the credit? And the answer is, in general, the 941 returns, your payroll, your federal payroll tax returns. But you could basically claim it in either one or a combination of these three different ways. One, you could reduce your federal tax deposits. Number two, you can file Form 7200s for an advance payment of the credit. And then number three is, like I just said, the 941 federal employment tax returns. I'm going to go into a little bit of detail on all three of these, just so you have a little more insight. So basically, they came out and said, in anticipation of the credit, the employer can reduce the amount of your federal tax deposits. This includes, so anything you're going to go through the EFTPS website, or if you write checks, if you're anticipating that you're going to get the credit and you have an idea of what it's going to be, you can just not pay in your federal tax deposit that you should have made. And they're saying, there's going to be no penalty for the underpayment of the employer's shares of taxes if the employer paid the qualified wages in the calendar quarter prior to the time of the required deposit. The amount of the employment tax is not deposited, reduced by any other applicable credits that we discussed a little earlier. And then if that's less or equal to the anticipated ERC, and three, the employer did not already seek an advance payment on Form 7200 for the same exact wages. But you can reduce your federal tax deposits, and you can still file for 7200s, the 7200 form, and I'll talk about that in just a second. And one thing I want to mention with these two is you want to be sure that you're going to qualify and you're going to be able to take this credit before you start doing this, because the last thing you want to do is have to pay this money back with some added interest and penalties. So it's a little riskier to do, especially if you're still in your covered period for your PPP loan and you haven't done those allocations yet between the wages. And if your wages fluctuate a lot during the quarters, this is a little bit of a riskier way to get the money, but you get to keep your your federal tax deposits, and then that'll basically just reduce the amount refunded. So the next thing is the Form 7200, which is basically an advance of the credit. So if you're already reducing your tax deposits, but you anticipate that you're going to have more credit than just the amount of the reduction that you're having in your deposits, which in most cases is probably true, you could file these forms to request an advance. So basically you have to file these any time before the end of the month following the quarter in which the qualified wages were paid, which is when you submit most of your payroll tax returns. But you can file these several times. I mean, you can do one every payroll period if you're really thinking you're going to get a lot of benefit out of this. But like I said, there is a risk factor involved with filing these. And then in order to file this, you're basically going to need to know most of the things you need to calculate the credit, which is you need to know if you qualify as a small business in this instance. So know your FTEs in 2019. You're going to want to know your qualified family sick leave wages that are eligible for the quarter and any of the other quarters we discussed. You're basically going to want to have that calculation almost part of the way done, or at least the things that are going to be deducted out of that credit, so that you don't overstate how much you want to get advanced to you. And then you also want to keep track of all, if you're reducing your federal tax deposits, you're going to want to keep track of those, because it's going to basically, the 7200 advance is going to be the difference between the amount you reduced and then the amount that you're going to get if you just filed normally at the end of the quarter for the ERC. And so the last item, and this is probably what most people are the most concerned with or have questions about, and that's filing your 941s and your 941Xs if you're going back into past quarters. So if you're retroactively claiming the credit from either going back to 2020 or first quarter of 2021, or it is the 28th, so most likely if you haven't done the calculation, you're probably going to be amending the second quarter as well. You're going to file a 941X amended federal tax return or federal employment tax return. Usually with these, you're going to request a refund. The money is usually being received around 6 to 9 months. So there is pretty, there's a pretty big time frame of when you're going to get this money. We haven't seen a lot of it come back for the ones that we've been filing, helping our clients with filing. So that is one thing to keep in mind, because the turnaround on a regular 941 is significantly shorter. The items you're going to need to file your amended return are, you're going to want to have a copy of your original 941, because there's going to be some numbers that you're going to need from that original 941, which it'll walk you through on the form. You're going to want wage reports listed by employee, and in those you want to include any, it's almost going to be like that calculation that we showed a couple slides ago with, you want to know the gross wage amounts for people, you want to know any qualified healthcare costs, and then you want to have those, that credit calculation where you're taking out any of those other credits that you can't use along and your PPP, and then you want to have your total amount of your credit ready to go. You want to have that number that you think you're going to get and see as a benefit before you file this return. And then you're going to want to file a worksheet 1, or fill out a worksheet 1, which I will talk about in a minute here. But that basically just helps you figure out how to fill out the 941 form, and kind of breaks out your credit number into a couple of different numbers. So for your current quarters and moving forward, you're going to want to file your regular 941. The employee retention credit has a couple of line items that you're going to additionally fill out. So all in all, you're going to have an amount due back to you by the time you're done at the end of the form. And basically, there's a couple items on the first page, or there's one item on the first page, and then a couple items on the second page that you're really going to want to enter in as far as your non-refundable portion of the credit, your refundable portion of the credit, and then how much qualified wages and healthcare costs you had that you were using in your calculations to get to those numbers. And then you're also, in order to do this, you're going to want to see the same things that you want for your 941X. You're going to want a wage report listed by employee with any qualified costs, additional costs with that. And then you're going to want to have the calculation done to show, the reduction of other credits and how much of the credit you're anticipating on getting. Okay. And then I've mentioned worksheet 1 a couple of times. Basically, it's found in the instructions of the 941 returns. There's one in the instructions to the 941, and there's another one which basically gets you the same numbers. There's a couple different items, but it's the same bottom numbers in the 941X instructions as well. Basically, it's a form with 3 different steps. First of all, it calculates out your non-refundable portion of the credit, and I put that in quotes because all of it is refundable. They just want you to calculate out what the employer portion of the Social Security taxes are, and they're calling that piece non-refundable. It's a different line item that you put on the 941, but all in all, you're still gonna add up to your total number that you're calculating. And step 1, it just basically reduces the amount of liability that they're originally going to say you owed. And then you add on the refundable portion, which is most likely the bulk of it, that will take out the rest and add up to that total credit. Step 2, that helps you figure out your sick and leave credits. If people were taking these in 2020, you might be familiar with this form. But basically, you just figure out your family sick leave credits. So if you're also using this with the ERC, you're going to want to fill out step 1 and step 2. But if you're not taking this, just fill out step 1 and then shoot right to step 3, which calculates your refundable portion, which basically says, how much qualified wages did you have, times it by whatever percent for whatever year you're filing, so 70% or 50%, depending on the year. And then it's taking out the qualified family leave credits, and it gives you your 2 line items, and it tells you where to put them on whether you're filing a 941 or a 941X. This is an optional form to submit with your payroll tax return, I would recommend just doing it. The more support that you can give the IRS, the less you might have to give if anything ever got audited over the period. So so this worksheet is essential to at least fill out and keep for your support. Okay. And then in general, we just kind of have some things that we want you to consider before claiming the credit. And one of the things is, will it be worth the expense to claim the ERC? This credit is, the IRS said this credit is not taxable, but it's not considered taxable income, but you can't take a deduction for the amount of the credit, and it has to net out against your wage expenses. So it is subject to expense disallowance rules. So like in this example, if you receive $100,000 in employee retention credit, then you have to reduce your deductible wage expenses by $100,000. So essentially this credit is taxable to you. So in most cases, the benefit is a lot greater than the reduction of your deductible expenses. So, but this is something to keep in mind, that this is taxable. And then another thing to keep in mind is, there's going to be amendments that have to happen, including the 941 forms, like I just discussed. And then the IRS is also saying, you have to net it against your wages, for the wages that you qualified in the year that you qualified them for. So if you're going back in 2020, you have to reduce your wages by that amount. But if you've already filed your, business tax return, your 1120, your 1065, whatever it may be, and your personal tax return, then that might mean that you need to amend. A lot of people at this point in time aren't necessarily amending. They're almost waiting to get the money, because you never know. The IRS might give you a different amount than you're expecting, or there might be some complications and maybe you don't get the credit. So, and then also I think a lot of people are holding out hope that the IRS comes out with something to say, just go ahead and file it when you're expecting to get the money, in the year you're expecting to get the money. Because I don't think the IRS wants a bunch of amended 941s and income tax returns and personal returns all to claim this credit, since so many people can qualify for this credit. So it is kind of overwhelming for the IRS. So hopefully they come out with something soon. This is a little bit of a gray area at this point in time. So just keep that in mind while you're thinking about, whether you're going to take this credit or not. Another thing is, which I already kind of touched on, but reducing your federal tax deposits and filing Form 7200s can be a little risky. If you don't know the total benefit that you're going to get, and you're just reducing all your federal tax deposits, and then you're also filing 7200s, there's a chance, especially if you have a PPP loan, that you're either going to receive more than your credit totaled out to be, or you might not be able to use all your PPP funds, and then you either have to pay back some of your PPP, or you have to pay back some of your ERC, so there is a risk to it. It will be a little better in the third and fourth quarters for these reduction in federal tax deposits, because it'll be a lot more easy to keep track of, because most people's covered periods for their PPP are ending soon, or they have already ended if they used an 8-week period. So just something to keep in mind. The overpayment, the refund that you're getting, keep in mind that it'll be, if you have any tax liabilities, it will offset that first before you get the money. So you might not get as much as you want. And then also the audit period. Usually payroll tax returns are about a 3-year audit period, but they have now extended it to 5 years. Since so many people are asking for refunds and we're dealing with a lot of money here, they extended the audit period. So you need to keep a lot of support, and you need to keep it for at least 5 years. And then the last thing is just kind of reach out to your payroll provider. Always see, a lot of payroll companies are assisting with the credit, not necessarily the calculation of it, but if you give them the numbers, they can at least file all the forms for you, which is something, which we can also help with those types of items too. But it might be worth it to talk to your payroll provider to see if what their how they're helping their clients do things. This is just kind of the employee records that you want to keep. You know, in a nutshell, it's basically everything. You know, you want all the documentation you use in the calculation of the credit, qualifying for the credit, you know, any record of your FTEs, you know, retain all the copies of the Form 7200s you filed with the IRS, and anything else really related to this credit. You just want to keep it all. You say 4 years here, I would say at least through the audit period, so I would change that to 5. But yeah, just anything that you use for support to go into the credit, definitely have a copy of it. So that's pretty much all we have on this for now. Here's our contact information. Everybody does have a copy of the slides, so hopefully, you know, if anybody has any questions, you know, feel free to reach out to us, or if you have a contact at Mueller already, reach out to them and they can reach out to us through that, or if they're proficient in it as well, they can help you out. But definitely feel free to reach out to us with any questions. We can really assist in any part of this process. We've been dealing with it for quite a while now, so definitely feel free to reach out. Here's our resources, and then yeah, is there any questions?
Hey, Dan,
At this point in
so
time?
I'm just looking at our questions
Mhm.
kind of area box here, and there are quite a few. I'm not sure if some of them have already been answered, but I can most assuredly start at the top here, and then if, you know, we're kind of running out of time here, so, you know, we can always reach out to those individuals directly.
We did have a lot of information here, and you know, yeah, it looks like we have about 2 minutes left in our meeting here, so maybe we could answer 1 or 2 real quick, I'm thinking. But like we said before at the beginning of the meeting, we can look at these questions after the meeting and get back to anybody who had questions.
Sure. So I can, I'll start at the top. The first question is, can you expand on a partial government shutdown for a non-essential business? And I think Natasha was talking about government shutdown at this time.
I gave an example about it, so hopefully you guys were able to kind of follow that example. But essentially what that means is it's probably going to pertain more to someone that had some essential, like let's say you had some parts of your business that were allowed to stay open, or let's say you could you had like a business that was, let's say you had a restaurant and the government said, oh, you can't have people inside of the restaurant, but you can kind of have people getting takeout or something. So really what you want to do is take a look at that business in 2019. Same thing you're doing for those essential businesses, is that if you take a look at that business in 2019 and you determine that in 2019 that business was more than 10% of your total gross receipts, or that you had more than 10% of the work done for your business on that particular portion that has been shut down, then you can consider that a partial shutdown. If your business was disrupted, maybe you didn't have to totally shut your business down, but let's say your office hours or your work hours were disrupted and they were kind of and they were cut down because you had to clean, or because the IRS said, or because your local government said you can't stay open past a particular time, then that would be considered a partial shutdown.
Great, thanks Natasha for that. Well, it is 1 o'clock, and as Dan mentioned, either one of them will reach out to you with those who had any questions. And I don't know if Dan and Natasha, you had any final thoughts or anything like that.
I just want to say, yeah, thank you everybody who attended. You know, feel free to, you all should have our contact information at this point, so feel free to reach out or to anybody at Mueller really, and they can get you in contact with the right person. And yeah, thank you everyone.
Yes, and each person should be receiving a copy of the slides afterwards, as well as a recording. So thank you, everyone, and have a great rest of your day.